Hello and greetings. Thank you for joining me. This is Dave Yeski, and I'm looking forward to spending a few minutes with you talking about what we've been experiencing in the past year, both economically and in the financial markets, and what we might expect going forward, and how we might best think about it and how we might best position ourselves. So thank you for spending a few minutes with me. So briefly, I'm going to be taking a few minutes to look backward and talk about what happened last year, both in the economy and the markets, um, what the implications are for this year, and in fact, I'm going to take a brief look at where we are year to date. Even though we're only 3 weeks in, there've already been some interesting changes. Then I'm going to take a broader survey of the U.S. and the world environment, focusing specifically on the headwinds that are a risk for global growth, and of course the financial markets that are just a reflection of the real economy. And we'll finally look at the what the ultimate prospects are for the economy, both the U.S. and the world economy, and the U.S. and world markets, as a consequence of all the headwinds, where we think those might resolve themselves or not resolve themselves. And finally, we'll talk about what the implications are for individuals as I think about the impact that the economy and the markets have on their own personal financial circumstances. So at the broadest level in 2018, we actually had very healthy economic growth, both globally and in the U.S. It was the first time we had what's been referred to as synchronized global growth. There were many years in the past decade when the U.S. was growing, and the rest of the world, or much of the rest of the world, was not, or where the U.S. was growing faster than the rest of the world. Last year, we had very fast growth pretty much in all regions, including and especially in the U.S. Economic growth in the U.S., it looks like, we don't have the final numbers yet, but it looks like economic growth for the year as a whole is going to be somewhere north of 3%, which is considered, for a mature economy like the U.S., is considered a very good rate of growth. So that was, from the macroeconomic realm, you would think, wow, that's all looking good. However, we had a number of headwinds, and we'll talk more about these in detail in a minute. We had growing trade concerns, especially between the United States and various countries. While the United States historically has participated in and fostered many multilateral trade arrangements between many countries or whole regions, under the Trump administration, there's been a focus on bilateral agreements, and a lot of the multilateral agreements have been abandoned. And this has led to a lot of trade friction, a lot of uncertainty. It's led to tariffs and threats of tariffs, and these have all had an impact. We also had a very active Federal Reserve, which is not only shrinking its balance sheet. I'll talk more about what that means in a few minutes, but it was also actively raising short-term interest rates in the form of the federal funds rate. It raised rates 4 times last year. We think that had an impact. And finally, Brexit. What happens in the UK matters. The UK is the fifth largest economy in the world, and their integration with the world trading system, their integration with the EU, is an important part of their participation in the global economy. And the whole Brexit proceeding has gotten a lot messier. Again, something we'll talk about in more detail momentarily. But that was the broad environment. Healthy economic growth in the U.S., healthy economic growth worldwide, but some emerging concerns and headwinds. So let's look at stock markets. This is just a measure of the global stock market. It's the MSCI All Country World Index. Practitioners refer to it by the acronym ACWI. But anyway, as you can see, the All Country World Index was rather flat for most of the year, and then took a dip at the very end, a very quite substantial dip in the final quarter of the year. Interestingly, if you just look at its performance over the last 2 years, you can see that world markets the year before, in 2017, were going gangbusters, and in fact, there's 2 things to note about this 2-year chart. First of all, you can note that during 2017 there was a very steady and actually quite impressive upward trajectory in the markets. But look at all of the bumps along the way. You can see that the volatility was very mild, very modest. And in fact, the volatility in 2017 was extremely low based on historical standards. And then, of course, what you see next is 2018, and not only did growth flatten out and, in fact, ultimately plunge in the final quarter, but look at the magnitude of those swings, much, much greater. One of the things to note about this is that the volatility level, sort of the day-by-day, week-by-week volatility that we see in the second half of this chart, is actually more normal than the volatility we see in the first half of the chart. So to the degree we all become sort of acclimated to whatever's going on in the recent past, I think we became quite acclimated not only to rising markets, but to markets that were that had relatively modest price moves in terms of the ups and downs on a day-by-day, week-by-week basis. In 2017, we didn't see days where the Dow would be up 3 or 4 or 500 points one day and down 3 or 4 or 500 points the next, whereas we saw a lot of that in 2018. And when you see this kind of volatility, I mean, the way to think about markets is they are big information processing. Well, I don't want to say machines because markets are actually organic. They're actually collections of human beings, but they are large crowds of human beings, you might say, who are collectively processing information as it rolls in. And when there seems to be less uncertainty, when there seem to be fewer storm clouds on the horizon, or there's a sense of greater certainty about what the economic environment looks like and what it's going to look like, then those human beings are processing information in a fairly quiet way. When there's increased uncertainty, when there's and a lot of the increased uncertainty we've seen is in the policy realm, so it's sort of self-inflicted in a way, then those large groups of human beings that make up the markets have more trouble processing the implications of new information as it rolls in. And that causes them to have wild swings one direction or another, because in the face of uncertainty, investors are more inclined to swing wildly between despair and enthusiasm, despair and elation, whatever. And so you get these wide swings because information is rolling in with a sort of a greater amount of uncertainty associated with it. So back to 2018, we see, of course, that this decline in the final quarter. But if we extend this to include the first 3 weeks of 2019, you could see that, in fact, 2/3 of the decline from last year was actually made up in the first 3 weeks of this year. Sometimes the markets can be like the weather, or what people say about the weather. If you don't like the weather today, just wait a few minutes or wait an hour. I mean, they certainly say it about San Francisco. It's why so many visitors from outside the city end up supporting the economy by buying fleeces, because you can be down in Fisherman's Wharf in the morning and it's 90 degrees and sunny, and all of a sudden 2 hours later the fog rolls in and the temperature drops 20 degrees. Anyway, the markets can be very much like that. If you don't like what you're seeing, wait a few minutes. And in fact, you could see that we had a very sharp rise in the first 3 weeks of this year that sort of wiped out anywhere between 50 and 70% of last year's decline. So, this is perhaps just another example of our heightened volatility, but there are some other things going on beneath the surface of this recent rise, and we'll sort of dissect that and burrow down into the details momentarily. So now, if we look at the performance by category, this is what happened last year. And as you can see, the U.S. blue chip stocks, as represented by the S&P 500, had the least decline. Small and small value stocks and international large and large value stocks had a larger decline. Now, as we look at the first 3 weeks, if we take these same categories and we expand it to look at the last 3 years, well, this has been the performance of the last 3 years, and this includes the declines of last year, and especially the last quarter of last year. So even given those declines over the last 3 years, all of these different categories and the market as a whole has had a quite a healthy rise. Now, if we take this into the new year and we say, okay, well, what did the first 3 weeks? This is performance through the 22nd of January, so literally the first 3 weeks of this year. You can see that all of a sudden there's been a big switch, and the blue chips as represented. Now, the EFA is an acronym that stands for Europe, Australasia, and the Far East, and it's an index of companies outside the U.S. that are kind of comparable to the S&P 500. They're what I call the blue chip companies. They're the largest companies in the market, and there's, just as the S&P 500 has names like Apple and General Motors and IBM and household names you'd expect, the EFA has the similar names. It's going to be Samsung, and it's going to be big European companies that are household, Nokia, whatever, they're household names in America. Well, those had the least impressive performance in the first part of the year, and all of a sudden, value stocks, both international and U.S. large value, and especially U.S. small value, those were the ones that were surging. And interestingly, 2 weeks ago, the Wall Street Journal observed that while there have been fears about slowing growth in earnings and profits among the blue chip stocks, both in the U.S. and around the world, for example, if you've been reading the headlines, you've noticed that Apple and other prominent companies have been reporting lower earnings expectations and lower profit expectations. That in fact, earnings and profits growth for the small company stocks have been rising. And have been rising impressively. So this is a case where all of a sudden, as we often see, we may be on the cusp of a leadership change where earnings are flattening out for large company stocks, but they're surging for small company stocks, because these different categories thrive at different times within the economic cycle, within what's known as the business cycle. So now let's move on for a moment to talk a little bit about some of the headwinds that are out there, because it's really important to acknowledge all of the things that have added to the volatility of the markets over the last year, continue to add to the volatility of the markets, and may in fact have a fundamental and negative impact on U.S. and world economic growth, which is, of course, the thing that fundamentally underpins anything that's happening in the financial markets. So certainly at the top line and sort of at the most aggregated level, what we're seeing around the world that's driving a lot of the policy decisions is decaying social cohesion. This is a scene of the so-called yellow jackets in France, and this is from the massive protests in Paris of the last month or so, and it's driven by many of the same things we've seen in the U.S. and the UK. I mean, this lack of social cohesion is not only driving change in France and has already over the last few years driven significant change in the U.S., but it was one of the things that led to Brexit. So we have slowing world economic growth, as reported by the IMF and other organizations that track that. We'll talk more about that. Trade wars, tariffs, the biggest being between the U.S. and China right now, but of course the bilateral trade is under threat in many different regions of the world. Brexit, a major impact right now. As I mentioned earlier, the UK is the fifth largest economy in the world, and if it disintegrates from the world trading system by separating from the EU, that's going to cause dislocations not just for the UK, but for all of its trading partners as well. The U.S. government shutdown, that's beginning to have an impact. It may have a very substantial impact if it doesn't get resolved. And finally, Federal Reserve policy. The Fed always has an important impact. And I should expand this to say not just Federal Reserve policy, but central bank policy around the world, because where the Fed goes these days, other central banks tend to follow. And so, to the degree the Fed is doing something good, and the European Central Bank or the Central Bank of Japan, or the Bank of Japan, I should say, follows, that could be a good thing. But if the Fed gets on a negative path and others follow, then it just, there's like contagion, and those bad decisions can spread worldwide. So the buzz at Davos, the World Economic Forum takes place in Davos, Switzerland every year, and it's sort of a by invitation only, and it's very expensive, but it captures a lot of headlines. And one of the things that came out in the early days, and was reported in the New York Times and elsewhere, because it was supposedly the early buzz at Davos, was a 22-page letter that billionaire hedge fund investor Seth Klarman sent to his investors, in which he observed it can't be business as usual amid constant protests, riots, shutdowns, and escalating social tensions. And he goes on to detail some of the things that we've just covered and will cover in terms of headwinds around the world. And because many people have asked me about this in the last few days, I like to bring it up. But I also like to point out that while we agree with many of his observations about the headwinds that exist in the world and the reasons for concern, we also agree with his sort of further high-level conclusion, which is, since the worst-case scenario does not frequently happen, you cannot let the fear of a monster storm completely paralyze you. And this is something I'm going to take make a little side note here. There's always negative things happening in the world, and we are evolved. It's part of our humanity to put a greater weight or emphasis on negative information in our environment. And this had huge survival value for our ancestors. There's this notion of a type 1 or a type 2 error. A type 1 error is when you assume something is true when it's not, and a type 2 error is when you assume something is not true when it is. And it turns out that when you're walking out of your cave and worrying about the saber-toothed tiger, type 2 errors have a much bigger survival cost. If you in fact make a type 1 error and you assume that the saber-toothed tiger is there every time, even though it isn't, you're much more likely to survive than if you make a type 2 error where you assume it's never there when in fact occasionally it is. So we're much more prone, we're evolved to minimize the risk of type 2 errors. But what that means is that we tend to put more weight on negative possibilities. And if there are multiple scenarios, we tend to gravitate towards the worst scenario. And I agree completely with Klarman that when you actually evaluate numerically and statistically, you see that, well, the worst scenario happens in a very tiny minority of the cases, even though it looms largest in our minds. So the IMF, the International Monetary Fund, recently came out with updated growth projections. And among the other things, they lowered their growth projections for global growth from 3.7% to 3.5% for the year 2019. And they cited a number of things: the risk of a no-deal Brexit, which is a so-called hard Brexit, the risk of escalating trade wars, especially between the U.S. and China, which is actually underway, it has been, and the impact of U.S. government shutdown, which is underway and continuing. And you could see from these charts that the blue line represents the revisions, and the revisions don't look huge, and they aren't, but they're significant in that it's a sort of a warning bell, or the canary in the coal mine, that things are shifting in the wrong direction. And they're shifting in the wrong direction for reasons that we collectively as human beings and policymakers may have some control over. But here again, the managing director of the IMF, Christine Lagarde, she went on to say, does that mean a global recession is around the corner? And she answers her own question, no. I mean, 3.5% growth is still growth, and in fact, it's quasi-healthy growth. When you look at emerging markets like China, you get into these weird situations where you say, well, Chinese growth, drastically dropped to an expected 6% or 6.5%, which of course is twice what we would ever expect from a developed market like the U.S. But it's much lower than what the Chinese economy experienced in prior years and prior decades. That's inevitable because, of course, as the Chinese economy has grown and grown to become the second largest in the world, um, maintaining rates of growth that percentage-wise are as large as they had been, 7, 8, 9, 10%, simply becomes impossible. You can't mobilize. You cannot continue to mobilize resources at the same rate when the economy grows to a certain magnitude, as is the case in the U.S. and Europe and Japan, more developed economies. Anyway, so more headwinds there. Federal Reserve policy. So the Fed last year raised short-term rates, which is in the form of the federal funds rate, 4 times, ultimately getting to, and they do it in a range, but their last increase in December was by another quarter point, which got us to the range of 2.25% to 2.5%. And the Fed at one point had been talking about possibly raising rates 3 to 4 more times next year. Oh, pardon me. Now this year in 2019. However, the increase in the increase in December, that fourth increase in December, combined with some pretty how do I put it, hawkish comments by Fed Chairman Jay Powell, in which he said, market turmoil should not be a reason for us to not keep raising rates. We think the economic fundamentals are strong. The economy continues to grow. Unemployment rate continues to be low. The fundamentals look sound. Well, markets didn't like that. Markets thought he was being much more rigid. And so in response to that, the Fed, first of all, the Fed lowered its projected number of increases this year from 3 to 2. And interestingly, there are ways of forecasting. There are ways of dissecting what market participants think and what they're projecting based on different market variables, including bond rates and stock futures. And to the degree that you can look at those economic variables and use them as predictors, the markets are actually predicting that the Fed may not raise rates at all this year. But certainly the Fed in their public statements have gone from saying 4 to 3 and now 2. And so we'll see where that goes. And then Fed Chairman Powell went further, and in comments in January, I think it was January 4th, he said, well, the Federal Reserve Board is going to take a very patient approach to raising rates, which is code for we're not in a hurry. We don't have to do 3. We don't have to do 2. We don't have to do any. And he went on to say that unwinding its balance sheet and also in unwinding its balance sheet, they may be more cautious, and that they would be sensitive to market signals. So all of a sudden now they're saying, well, whatever they think is going on in the economy, they're not going to be blind and deaf to what's going on in the financial markets, because the financial markets send important signals about the future. The whole notion of unwinding its balance sheet, by the way, is related to this thing I'm sure you read about in prior years called quantitative easing, where the Fed, once it had lowered short-term interest rates near zero, really couldn't do much more with interest rates at the short end, and so it wanted to keep rates lower at the longer end of the spectrum, and it did that by going out and becoming a big buyer of bonds. And so they started when market participants are buying bonds, when there's a lot of bond buying activity, it drives up the price, and when the price of a bond goes up, the yield comes down. So normally we say the Fed controls short-term interest rates, but long-term rates are set by bond investors, which is to say the private market. But long-term rates are always set by bond investors. But when the Federal Reserve decides to be a big bond investor, it's the big gorilla in the room, and so it has enough buying power. And it was buying $100 billion a month worth of bonds. It has enough buying power to drive up prices and keep rates down. Well, the Fed stopped doing that. It ceased its quantitative easing. And whereas previously it had been rolling the bonds in its portfolio over, if it had bought a 5-year bond and the bond matured, it would actually buy another 5-year bond. Well, it stopped doing that. So what was happening is its bond portfolio was getting smaller and smaller, and that was easing. That was sort of, not only were they no longer buying bonds, but by allowing their bond portfolio, their balance sheet, if you will, to begin shrinking naturally, they were beginning to take a contractionary approach. anyway, so the Fed chair has now sent signals that they may even be slowing down on what they do with their balance sheet of bonds. And perhaps not surprisingly, the market rallied on Powell's comments that because this was all positive, the market is concerned with slowing economic growth, and all other things being equal, you don't want to be tightening monetary conditions in the face of slowing economic growth. So speaking of the Fed, so a lot of there's been some news in recent months about this concept of an inverted yield curve. And an inverted yield curve is one where short-term rates actually end up being higher than long-term rates. This is the current yield curve, which you can see is getting pretty flat. And of course, the flatter it gets, the greater the risk that the short rates will exceed long rates. This is what it looked like. This is what it looked like 2 years ago. Now, one thing that's worth noting is that to the degree the yield curve is getting really flat, it's getting flat not because long rates are going down, but because short rates are coming up. Well, why are short rates coming up? They're coming up because the Federal Reserve is driving them up. So when people talk about the risk of an inverted yield curve, they'll say, well, 7 of the 8 last times that depending on how you measure it, that the yield curve became inverted, it was followed by a recession. There's about 4 things to say to that. One is to say that that's a pretty small data set. Even if 7 of the last 8 times the yield curve inverted, there was a recession following. That doesn't mean there'll be one in the next time. And that data set is just too small to really be used for prediction. Secondly, if you expand this study, actually Dimensional Fund Advisors did a recent study in which they looked at this question, not just in the U.S., but they looked at global markets so they could get a lot more data points. And they found that to the degree there was any correlation, recessions, if they followed at all, they followed sometimes with a great lag, sometimes years later. And so this is one of those things where you don't want to jump out of the market at the first sign of an inverted yield curve, because you may give up years of additional market growth while waiting for the recession. But the other thing that's worth noting is that it's at some level this observation is somewhat trivial in that inverted yield curves almost invariably arise for the same reason that short-term rates are rising now, because the Federal Reserve was raising rates. When the Federal Reserve is worried about inflation, they raise short-term rates, and they often overshoot the mark. And if they overshoot the mark, it chills the economy down, it slows down economic activity, and we go into a recession. And if you look back at all the different times this has happened, it's almost all been instances where the Federal Reserve is raising short-term rates. It could conceivably happen, and there's a few instances of this, where bond investors at the longer end of the spectrum are looking out on the horizon and collectively predicting an economic slowdown. And with an economic slowdown, they predict that inflation is going to fall and rates are going to fall. And of course, if interest rates fall, then bond investors make a profit because prices rise when interest rates fall. So that could cause long-term investors to invest in longer-term bonds, anticipating a fall in inflation and a fall in interest rates. And if their prediction is correct, then we have a recession. So you can tell economic stories for why this may predict a recession, but I think for a lot of reasons we're a long ways from worrying about this in terms of our current economic environment. First of all, it's not yet inverted. Secondly, the Federal Reserve, I think, is going to be much more cautious than maybe has been the case in the past. And third, there's just no sign of inflation on the horizon. Okay, now let's come back to Brexit. Will it be a hard Brexit or soft? As I mentioned earlier, hard Brexit is this notion that on March 20, the UK will bounce out of the European Union with no agreement whatsoever. For those of you who follow the news, Prime Minister Theresa May has negotiated repeatedly with the European Union leadership and developed a series of deals. And I think she's gotten at this point the best deal she's ever going to get out of Brussels. And she brought it back to the Parliament and suffered the worst defeat for a motion in Parliament, I think, ever. making it clear that that deal was dead on arrival. So the question becomes, what comes next? Um, for some reason, although Theresa May was a Remainer back in 2016 when the original vote was taken, she somewhere along the line she decided that she needed to follow the quote unquote will of the people, even though the Exeters only won the vote by 51 with a score of 51.9%. Um, she has seemingly become very committed to the exit. But we may see that change. We may see that change. There's a lot of talk now that the only path forward is to have another referendum, because it looks like public sentiment has shifted. And the one thing that's absolutely undeniable is a lot of public figures lied to the British public during that original referendum in terms of what the impact of Brexit would be. And the public seems to have come to its senses. At least if you look at polls, it looks like a referendum taken today would be the exact opposite, that it would, by a not insignificant margin, favor remaining. Because human beings are pretty rational when they're faced with the facts. And when they're actually when they have lived experience that shows the lies that they were fed back in 2016. I know for those readers of The Economist magazine, I'm sure you've noted in the last two issues, then they talked about this. They've certainly predicted that this is a rising possibility, and the editors of The Economist also think it's the best way to go. As messy as every option is, going back for another referendum is probably the best one to go. And a revised decision to remain would probably be best for the UK economy, and probably be best for the world economy. And of course, we have the U.S. government shutdown now in its 32nd day, making it by a factor of two. Well, not by a factor of two, but it's certainly the longest ever. And of course, we're continuing to count. Its impact on the economy is already being felt. If it continues, the impact is going to continue further. And of course, it's not just those 800,000 federal workers who are not getting paychecks. It's the ripple effect. I mean, we have a multiplier effect in the economy. Every time somebody earns a paycheck, they spend their paycheck, and their expenditure becomes someone else's income or some other company's profit. And those create these ripple effects, these multiplier effects. So when you also shrink it by having a shutdown like this, you have reverse multiplier effects. And so yes, there is an impact on the economy, and it's bigger than one might think. And the impact will continue and grow larger as the shutdown continues. So the question is, how much longer? Is there going to be movement towards compromise? There seems like there may be some movement going on now. There are some pinch points and pain points all the way around. And certainly some action in the Senate today may crack a door open towards possible compromise. And we'll just have to wait and see. We may get into it. We may muddle through. And we'll talk more about muddling through in a few minutes. In fact, we'll talk more about muddling through now. I'd like to provide a little history here, and this is obviously very recent history. The concept of muddling through. There's a significant degree to which we can easily forget that we tend to swing from one crisis to the next. We could talk. I'm not even going to go far enough back to talk about the Great Recession in 2008. The Great Recession, the real estate bubble, however you want to describe that. That was obviously a major crisis. But right on the heels of that, actually starting in 2009 and fully blossoming in 2010, was the first Greek debt crisis, followed in 2012 by the second Greek debt crisis. And you may recall these roiled markets both in the European Union and actually throughout the world. And then in 2013, we had the fiscal cliff, where at the beginning of 2013, we had a harmonic convergence in the U.S. where these automatic spending cuts that had been put in place that were so draconian that the policymakers who had put them in place a few years before were convinced that Congress would come together and come up with alternative solutions, and Congress didn't and couldn't. And so we were looking at this situation where you're going to have drastic spending cuts hitting at the same time that you had rising debt, and we ended up muddling through from that. Lawmakers only at the 11th hour, or maybe the 12th hour is a better way of putting it, came through and made the modifications that needed to stave off a crisis. And then, of course, in 2013, later in 2013, towards the end of the year, we had a government shutdown. That one lasted 16 days, exactly one half of the duration of our current government shutdown. But that was another one that roiled the markets, and actually the combination of and that was the one that had actually led to S&P lowering the credit rating for the first time ever, lowering the credit rating on U.S. government debt, which was a stupid thing for S&P to do, but that's a whole other conversation that I'll leave for another day. In 2013 to 14, we had the Ukrainian crisis when Russia invaded Ukraine and specifically Crimea and seized Crimea and then fostered an ongoing conflict in the eastern part of Ukraine. And this roiled financial markets for a while. In 2015, we had the Chinese stock market crash, which again roiled markets. In 2016, we had the Brexit vote, which again roiled markets. But if you look back, notwithstanding the volatility that each of these contributed to the market actually rose in 2010, 12, 13, 14, 15, and 16. So it's, there's this old saying that the market climbs a wall of worry. It's very easy to become hypnotized or distracted by the wall of worry, but the markets tend to see the deep regularities beneath the surface, even though it adds to the volatility as uncertainty increases and market participants try and digest the daily news in the face of greater uncertainty. It causes more volatility at the surface, but fundamentals tend to out, and so you have a situation where you have greater volatility. It feels like things are falling apart, but at the end of the day, the markets rise, and the economy in the U.S. and around the world continues to advance. So if I can paraphrase Churchill, who was referring to, he had a quote referring to the United States during World War II when Britain was still desperately waiting for assistance in the face of the German onslaught. I'm going to paraphrase what he said about the U.S. and say, U.S. and global policymakers tend to do the right thing in the end, but only after exhausting every other possibility. And we've seen that again and again. We saw it in the list on the prior slide where everything got resolved, but it got resolved at the 11th hour, but after a lot of turmoil. I tend to think that's where we're going to be in the present day. We have a lot of these hot spots, a lot of these headwinds, but I don't think we're going to see the worst scenario play out, because the worst scenario almost never plays out, even though it's the one that captures our attention. So let's now take a little bit more positive look at the global landscape on a forward-looking basis. So, you've heard a lot of talk about how last year, and this is mostly based on the Dow Jones Industrial Average or the S&P 500, but a lot of commentators at the end of the year, which is to say at the beginning of January, you saw the headlines saying that 2018 was the worst decline in the markets in a decade. But of course, it was also the first decline in a decade. If you look at that little red bar on the right, you can see that, yes, it was a decline, and it was the first one since 2008, but compare it to 2008. Or for that matter, compare it to even 2000, 2001, and 2002, which of course were the market declines that followed the dot-com bubble bursting and then 9/11 and the recession that followed. Those were all, every one of those 4 years was much worse. And so we have to keep things in perspective. It's always possible to take anything and conjure an ugly headline out of it. And of course, that's what newspapers and news shows do. And they do it because, again, we are evolved to pay more attention to negative news than positive. And so the media is not being negative. They're just feeding us what they know is going to get our attention. So the other thing to look at is that sooner or later there will always be a shift in market leadership. Nothing remains the same. There's a propensity for this thing that's called reversion to the mean, which is to say that one category, one market, or one category of investment may do really well for a while, but sooner or later gravity kicks in and it tends to fall back towards some normal level of return. And the same thing happens on the downside. You may have a market or a category of market that does very poorly for a while, but sooner or later it will recover and return to some, you can't see the air quotes I'm doing, but some normal rate of return. And so we see these shifts back and forth, and sometimes they're quite dramatic and sometimes not. But one of the things that's worth noting is that U.S. and international markets tend to trade leadership. Recently, the U.S. has tended to be on top. Now, what this chart, just to like break down what you're looking at on this chart, the way I constructed this chart is I took the return to the U.S. market, and in each year, this is actually this is a 12-month rolling average that's reported every month. 12-month rolling average reported monthly. And so what I did is I showed, I took the 12-month rolling average for the U.S. market each month, and I subtracted from it the 12-month rolling average for the non-U.S. market, for the international market. And so what that means is if the U.S. market had a higher return, it created positive bars on the top. If the international market had a higher return, it created a negative bar on the bottom. So all those bars on the top are months in which the 12-month rolling average was where the U.S. dominated, and all those on the bottom are periods where international markets dominated. And what you can see is that they trade leadership back and forth, but not in a predictable way. The biggest takeaway, there are two takeaways for you to have from this chart. One, U.S. and international markets, neither one of them dominates forever. They regularly trade leadership. The second takeaway is they don't trade leadership in a predictable fashion. Now, one of the things you'll see on the right-hand side of the chart is that for the last 10 years, the U.S. has tended to be on top much more often than international markets. But I think that there's a couple of reasons to believe that prior trends will reassert themselves, and there'll be a time for international markets to have their turn in the lead. And among those are that the U.S. has actually been ahead of international markets in terms of our stage in the business cycle. The U.S. came out of the Great Recession sooner and stayed in a growth pattern longer than those other markets did. Policymakers in the UK, in the UK, policymakers in the UK and the Eurozone, and policymakers in Japan prematurely tightened monetary conditions coming out of the Great Recession. And it sent them back into a double-dip recession. Now, here in the U.S., we were blessed to have Ben Bernanke as head of the Federal Reserve. Ben Bernanke, who is probably the world's greatest scholar of the Great Depression, happened to be at the helm of the Federal Reserve when what could have been the second Great Depression came upon us. And so he made decisions that allowed the U.S. to recover sooner and to remain in recovery, whereas other countries made different decisions and it didn't work out so well. However, eventually, central bankers in those other countries and those other regions, observing what was happening in the U.S., did an about-face, reversed themselves, lowered short-term interest rates, and in fact, in the EU, the European Central Bank started doing quantitative easing, which had already been going on in the U.S., where they were buying $100 billion worth of euros every month, and that put all of those economies back on a recovery path, but they started later. So we've been in recovery a lot longer. Our recovery is longer in the tooth, you could say. And as a consequence, there's probably more room to run in those other economies. When you look at magnitude of market, when you look at market valuations in the U.S., they're much higher than market valuations. For example, using the price-to-earnings ratio, which is a common benchmark for how expensive stocks are, the price-to-earnings ratio in the U.S. is much higher. Even on a forward-looking basis, it's between 15 and 16, whereas globally, the rest of the world, it's closer to 10 to 11, which suggests market valuations outside the U.S. being lower and economies being in an early stage of recovery, there's more upside potential there. So those are some macro reasons to think that it may be the international market's turn. And of course, this also implies you should be a global investor, which we believe in. Half of our client portfolios are invested outside the U.S. for this very reason. There was a question about the scale of this chart, and the reason that I didn't put the scale on here is because it wouldn't actually be representing returns. Because I'm subtracting one return from another, if you saw a 5% return for the U.S., but in fact international markets had a 10% return, it meant that the actual return to the U.S. would be 15%. So these bars are showing the differential between U.S. and international performance, not the actual performance, and that's the reason I left the scale off, because it would be too easy to interpret those as returns instead of the differential in returns. But Mark, I'm happy to send you a chart that includes the scale so you can see how big those differentials are. And actually, I'm happy to send that to anyone who wants. Just drop me a line and I'll send you a chart that shows the scale of the differential performance between U.S. and international markets. So now, next, again, sooner or later, there will be a shift in market leadership in other areas, including large company stocks versus small, and growth stocks versus value stocks. You know, we talk about the fact when we're building portfolios, we talk about being evidence-based, and we talk about using the best available evidence for bringing together market factors, market segments that we believe have are associated with the highest returns. And that includes small company stocks, which tend to have higher returns than large company stocks, and value stocks, which are stocks that are trading at a lower price relative to their earnings or assets, that tend to have a higher return than growth stocks. However, those things tend to manifest themselves over a period of years. If we talk about the fact that small company stocks have higher returns over the long run because they have some unique risk associated with them. Well, there would be no unique risk if they had higher returns every year. If they had higher returns every year, that wouldn't be a risk factor. The fact that they don't have higher returns every year is related to the risk factor. They have higher returns over a span of years. This is one of the reasons we don't put 100% of your portfolio in small company stocks, is because they're subject to what the economists call temporal clustering. Over any given 5 or 7 year period, they're most likely going to have the higher returns than large company stocks, but they may get there they may get there by blowing off the doors in the last 3 years of that period. I experienced that back in the dot-com era. In 1995 to the beginning of 2000, the stocks that dominated the market were the big blue chip stocks, and especially the technology stocks, Cisco and its like, and the small stocks and the small value stocks, both in the U.S. and outside the U.S., they mostly had positive returns, but they were lagging behind those other categories. And that was for a 4 or 5 year period that they were lagging behind those big blue chip stocks and those technology stocks. But when everything fell apart in 2000, when the dot-com bubble burst and it was followed by a recession, well, those stocks that had been leading, they dropped by 15 or 20% and more. Those those small company stocks in the U.S. and outside the U.S. actually had huge returns in 2000. The domestic small caps went up 20%. The foreign small caps went up 30%. And then when we came out of that recession in 2003, 2003 through 2007, it was the small company stocks that dominated everything else. So if you just base your decisions on what was going on in the latter half of the 90s, you wouldn't want to own small company stocks. But if you didn't own small company stocks, first of all, you wouldn't have been rescued from the meltdown of 2000. And secondly, you wouldn't have gotten that great growth following the recovery in 2003. So let's look at that. We may be seeing the beginning of that. You saw this chart earlier. This is the first 3 weeks of 2019, and what are we seeing dominating? We're seeing U.S. small and small value, and U.S. large value and international large value are dominating the other categories. And so we may be seeing that shift in leadership that historically we've always seen. So the thing that we think you need to do, we all need to do when thinking about this heightened volatility, that this is, there's every reason to believe the heightened volatility is going to continue. We're best to just assume it's going to continue. Assume, and I don't even want to say that's the new normal, because that actually is the normal. That, as I showed in the earlier chart, 2017, that was the unnatural, the non-normal experience. What we saw last year was the more normal level of volatility. So let's, going forward, just basically reset your expectations that you're going to see very volatile markets. You're going to see these multi-hundred point rises and falls in the Dow and similar percentage moves in other markets on a regular basis. But focus on those deep regularities. Think about the fact that human beings tend to be adaptive. They tend to be growth-seeking and resilient, and that's why when we look at these long-term charts of the markets and the economy, we see that no matter how volatile they are, they tend to rise over time. And it's because the individual human beings are following their own interests, and they're adapting to changes, and they're seeking growth for themselves and their families, and that aggregates up to an economy that's resilient and growth oriented. And so the stock market, it's just a secondary, it just represents ownership of the productive assets of the economy. So it's a reflection of and follows what's going on in the real economy. That's going to move ultimately based on those deep regularities in the economy. There's a metaphor we've used in the past that I think is relevant here. If you were watching someone walk their dog across the park, and you wanted to know where that dog walker and dog were going to end up, would you watch the dog or would you watch the dog walker? Well, obviously you'd watch the dog walker, because the dog walker is walking in a straight line, and the dog walker knows where it's going. The dog walker has some deep regularity. The dog walker, she has a path that she's following and a destination. The dog is going to be all over the place, forward and back and right and left, and depending on how big a lead the dog walker has given the dog, it's going to cover a lot of territory. If you watch the dog, you have no idea what's going on. You just see the surface volatility. So this is another case where look at the deep regularities in the economy. Those will ultimately be reflected in the markets, but not without a lot of daily and monthly and weekly volatility, because the markets are like the dog. They're distracted by every blip along the way, every piece of trash in the grass and anything else. So, and of course, short-term prediction is impossible when you're dealing with things as chaotic as this. And when things are moving based on new information, you would have to be able to predict the news to be able to predict the markets. And since I've yet to meet anyone who can predict tomorrow's news, I've likewise never met anyone who can predict tomorrow's markets. And so we have to instead build resilience into our affairs. So if I can wrap up and summarize, last year was a challenging year in the market, although not so much for the economy, but the heightened volatility was very much in line with our long-term norms. We have a lot of policy headwinds in 2019, and many of them were and are self-inflicted. And so that's good news and bad news. I mean, it certainly is bad news that we have a lot of policy headwinds that were not necessary. But the good news is that being self-inflicted, it means the policymakers, whether they do it at the 11th hour or the 12th hour, they still have room to muddle through and correct course. And the history suggests that in the end, if you can only think probabilistically, right? We don't know what the future is going to hold. We don't know what tomorrow is going to hold. So we can only say, what's the most likely outcome? Well, the least likely outcome is the worst scenario, and maybe the best scenario is likewise has a similarly low probability. But some reasonable probability, probably some reasonable outcome, some reasonable scenario, some muddle-through scenario has a much higher probability of materializing than the worst case. And so if we're going to be thinking probabilistically, we're going to bet on at least a muddle through, and maybe better. If we just look at the macro trends, like trends in earnings and profits for companies, there's reason to think maybe this is the time we're going to see a shift towards small company stocks. It would not be unusual for this stage of the economic cycle. They're less tied to, they're less prone to trade disruption and the like. And it's also true that global diversification continues to be justified And there's ever more reason to think that a globally diversified portfolio is going to outperform a much more focused portfolio. So, in the end, and as always, resilience is the watchword. So, I hope that the last hour has proved somewhat interesting. I hope it's been somewhat interesting and informative. We are happy to talk about any of these topics at greater length. Any of you who are interested should call us or email us, and we'll have a conversation. We'll burrow into the details on any of these things. And in the meanwhile, I will just say, I'm seeing no more questions rolling in. I'll just say, be happy, Happy New Year, and buckle your seatbelt. It'll be an interesting year.